Investor Connect podcast program. This is Hall T. Martin. I'm the host of the show, in which we interview angel investors, venture capital, private equity, family offices, and many other investor groups for startups and growth companies. I hope you enjoy this episode. Thank you for joining us. Well, hello, this is Hall Martin with Investor Connect. Today I'm here with Tim Hoerr of Serra Ventures. Tim, thank you for joining us.
Yeah, it's great to be here.
Great. Can you tell us about your background before you started investing in early stage companies?
Yeah, I spent 15 years in public accounting, the management consulting side, both here in Illinois and then on the West Coast, San Diego. And that was kind of chapter one of my career, I guess. Chapter two, I ended up spearheading a couple of tech companies, spent a couple of years at a software company that was taking the very new Mosaic browser down to cell phones and personal digital assistants. This would have been sort of circa 2000. And then had the opportunity to co-found a scientific instrument company here in Illinois. And that ended up being about an 8-year journey. So all those together kind of were my tech entrepreneurship chapter. And then started a consulting firm that morphed into a venture firm after selling the scientific instrument company to Sony.
Well, you've seen a lot of startup investing in your career. For the investors that are listening, what's your advice for people that are just now starting to invest in the startup stage?
Yeah, I would say obviously build a very diverse portfolio. Early stage companies by definition they're very high risk. It's difficult to predict the outcome. There's a number of risk fronts that need to be mitigated over time. So obviously diversification, which is kind of a basic investment strategy for any type of investing thesis. But number two, absolutely focus on the teams and the quality of the teams. So you need teams with great competency, but you also need teams with great teachability and humility. And we find that that's kind of a rare combination that you get both of those in one package. And then I'd say in the early stage investing space, you've certainly got to embrace the long haul. This is not a 2 or a 3 or even a 5-year gig. You've got to commit when the mean time to exit on an early stage deal is somewhere in the 8-year range. I mean, that's the average. So you may see a few deals earlier than that, but you're going to see some deals on the other side of that. So embrace the long haul. And then I think the last thing I'd say is, as an investor, find some way to add value to the companies that you're investing in, something that goes beyond writing the check, so to speak. So bring your expertise to the table, bring your experience, bring your connections, find a way to add some value.
Well, that's good advice. So you've been seeing the venture industry for many years. How do you see it evolving and changing today? It seems like it's rapidly changing in the structure and the stages and where it's being done, but what do you see out there?
Yeah, and again, our domain is primarily the early stage, so Series Seed and Series A rounds of tech companies. But I think some of the trends that we see happening, number one, we see larger rounds happening at each juncture point. So today's seed round was probably yesterday's A round, so to speak. So larger amounts of money being raised at each stage. I would say in terms of venture firms, they tend to be making later, their initial entry point seems to be slipping later into the life cycle. I know that's true of us. Our first fund started out as I would characterize as kind of bleeding edge, early opportunities, pre-revenue in most cases, whereas today we're looking at coming into companies that are perhaps a year and a half or two into their journey, and they're typically post-revenue. So I think that later entry point. A third thing, we continue to be amazed at the great deal quality. So the quality of the inbound opportunities, and we tend to see 10, 12, 15 per week. That is certainly higher today than it was 5, 7, or 10 years ago. And then sort of a companion point to this is a lot of these great opportunities are in non-traditional tech ecosystems, right? So be that the Midwest, which is the milieu that we work in, or elsewhere. It doesn't necessarily have to be on the West or East Coast. So we're seeing some really nice maturation in these center of the country tech ecosystems.
So if you look out today, what do you think is the biggest impact on returns? You talked about the importance of the team. Is it the team or is it a combination of other factors that you look for that you think has the biggest impact on the final returns you get?
Yeah, it's a number of things. I think the team is certainly critical, and particularly a team that's probably been there and done that. So, in addition to the competence and the humility, teachability, and so forth, we do look for a team that has experience. I also see that companies have to be relatively patient with this long mean time to exit. And when we see that, even in the recent trend of a lot of the IPOs that have been happening, a number of these companies now have been around for considerably longer than some of the tech companies of 10 or 15 years ago getting to IPO. So I think that's certainly a big impact. And I would say for early stage investors, one of the things we see is that those follow-on rounds, and not only the amount of money that's raised, but the terms at which that money is raised, tend to have a pretty significant impact on the early investors. So if you're not able to continue to follow on and not be diluted, and in certain cases, you just can't avoid some of the preferences and things that are layered on in later rounds. So those also tend to have a fairly big impact on returns for those that did get in early.
So for your fund, what is the specific investment thesis, or better, what is the criteria of the deals that you look for in, aside from a great team, what kind of revenue sector or stage do they need to be at to get on your radar?
Yeah, so we typically look at companies that are revenue generating, and we do make some exceptions for that, but we most often want to see at least $250,000 to $500,000 in revenue at the point of initial investment. And that typically translates again into a series seed or a seed plus or a seed extension type situation. So that's where the company needs to be revenue wise. For us too, we tend to focus on some specific tech sectors and others not so much. But we, like all investors, you want to see a relatively big market that's characterized by the B word, right? That there's billions in revenue opportunity. We take a pretty stringent view of disruptive intellectual property. And so not just kind of a better mousetrap to solve a problem, but is the intellectual property behind the solution truly disruptive, and is it hard to replicate? So maybe more deep science type stuff behind the technology. So that's an important one for us. I guess it sort of goes without saying that because of the fact that we want to see 250 to 500 in revenue, that means we also want to see that the product market fit has been pretty well defined and the company has a really good grip on that. So those are some of the key criteria. And then, of course, any given opportunity has got to be priced right and the terms have to be right. I mean, it has to fit with all of the other elements of the equation, and it has to be also fitting with the market, right? You want to be able to blend all of these things together and make sure you're doing a deal that's at market as opposed to paying too much.
So what are some example startups that fit that thesis? Do you have a couple of portfolios that you'd like to call out and show as an example?
Yeah, we have about 70 companies spread across three main portfolios. A company right here in our hometown called Reconstruct that was launched by some folks at the University of Illinois. So it's a software platform in the construction space. It integrates a variety of data sources, so pictures and images for one. It integrates project scheduling. It integrates data from budgets and so forth, and gives a real-time understanding to folks that are managing construction projects on where the current problems are. It's predictive in terms of how the project might get off schedule, et cetera. So this is a company that's probably going to do about 3.5 or 4 million in revenue this year. We first came into the company a couple of years ago. They had a small revenue run rate at the time that fit our profile, but team, very interesting, couple of professors, but also an individual that had been in the construction industry for about 10 years. So we very, very much focused on the team in this case, but also said, hey, this is a very sciencey piece of software that has some really nice IP behind it, could potentially be really disruptive to this construction space. So that's an example of a company that's the type of company we're looking for when we do a deal. Brand new company that we just did out of Des Moines, Iowa. It's called WebCare Health. And WebCare Health is both a software platform and a device for the monitoring of coumadin levels in patients with that particular condition. And they've got several thousand patients on the platform. It was a company started by a physician and a couple of business folks, has slowly been gaining traction over its initial tenure, if you go back sort of 4 or 5 years. So it's a company that we have just invested in, the Series A. Company's at about a $5 million run rate, so a more substantial amount of revenue, but again, a solution that's very well conceived and now establishing sort of a nice dominant market position. So that again is an example of a startup that fits well with our parameters.
Well, those are two good examples. But in general, when you look at the startups that you're funding, what are typically the challenges they face in growing their business? Is it revenue traction? Is it strategy? Is it regulatory? Is it market? Where do you see the challenges that they have to overcome?
Well, the challenges and risks come in a variety of categories. So certainly market challenges can be huge because in this day and age, competition can develop rapidly. Competitors that weren't in the market 3 or 6 months ago can emerge, and they can be relatively well funded. So that's certainly a concern. Being able to obtain continuous rounds of funding along the way. So if the company's growing rapidly, got to be able to access the capital to fuel that growth, because often growth comes along with prolific losses on the bottom line. I would say one of the key challenges companies face is certainly, and I'm going to say this with all due respect, humans being stupid. And it just never ceases to amaze me that humans can go a long way toward letting their egos get in the way of a good decision, or a relationship that deteriorates both inside the company or out. So that is the most sort of unpredictable factor, is what is a human going to do that maybe isn't the most rational decision that benefits the company and the shareholders. It's a decision maybe made in isolation that they perceive to benefit them. So that's also a huge risk.
Good. Well, you see a lot of sectors and applications out there. If you had to pick out a couple of specific applications that you think are great immediate opportunities to pursue, what would you call out as maybe the top 2 or 3?
Well, we see some great things happening in artificial intelligence enabled applications, and that's across a lot of different sectors. So we are very interested in anything conceived in the AI space. I think that's a hot one at the moment. We're seeing a lot in AgTech, and this can kind of run the gamut from Internet of Things to precision planning to big data. And so AgTech is a relatively hot space. Ag and food, I guess I should qualify it. And of course, healthcare IT, I think, continues to be a super hot space. Those would be some of the sectors that we see as deserving quite a bit of attention right now.
Well, great. Well, in the last few minutes that we have here, what else should we cover that we haven't?
Well, I think you've asked a lot of great questions, Hall. I would just, as a blanket statement, this time in history is what I sense to be a great time for both entrepreneurs and investors. I think it's great on both sides of the table. There's so many tools available today. There are so many elements of outsourcing available that can help grow your company. And then, as I said earlier, you've got these tech ecosystems that have emerged in unlikely places like Madison, Wisconsin, or Lincoln, Nebraska, along with the more obvious Austin, Texas, and San Diego, and so forth. So there's a great set of milieus out there that are facilitating great entrepreneurship. There appear to be more and more investment dollars becoming available through novel sources like crowdfunding and so forth. So it's a great time to be an entrepreneur. It's a great time to be an investor in tech and in early stage tech in particular.
Great. Well, we appreciate that information. So how best for your listeners to get back in touch with you?
So the best way is my LinkedIn profile, Tim Hoerr, Hoerr, or Tim at serraventures.com. And Serra is Serra. So Tim at serraventures.com or the LinkedIn profile. Those are probably the best ways to get in touch.
Well, great. We'll put those in the show notes, and looking forward to having you back for a follow-up soon, and want to thank you for taking time.
You bet. It's been a pleasure.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.